3 o'clock, it is showtime. Welcome everyone, and thank you all for being here. My name is Mark Dickens, and I'll be your host and MC for today. So first off, I'd like to thank Mara for the invite and the invitation to be here with you all this afternoon. Canadian by blood, so it always means a lot to me working with the Canadian Chamber of Commerce. I think I need to talk a little closer to the mic. So first and foremost, I think the last time I've been surrounded by so many lawyers is either in a lot of trouble or had some expensive bills coming my way. So all that to say, I am excited for the session. I think you guys are going to hear some really interesting case studies today that are real world and will showcase some examples between a real life situation, client and lawyer, and that's much better. And so I'm hoping that you guys enjoy the session today. As I said, my name's Mark. If you don't know me, I am Mike's nephew, younger, handsomer, and his new replacement. So to officially start today, I'd like to invite Mara up to kick off today's session before we get rolling. So Mara is the Executive Director for the Canadian Chamber of Commerce, so welcome to the stage, Mara.
Good afternoon. Oh, that's a little high. Good afternoon, everyone. On behalf of the Canadian Chamber of Commerce in Vietnam, I am delighted to welcome you to the Vietnamese Legislation Case Study Seminar. The Canadian Chamber of Commerce in Vietnam, CanCham, has proudly served the business community for 25 years, fostering trade, investment, and partnerships between Canada and Vietnam. Our mission is to connect people, ideas, and opportunities, and today's seminar is very much part of that mission. We are proud to host this event in collaboration with the Consulate General of Canada in Ho Chi Minh City, and we sincerely thank the Consulate for their continued partnership and their commitment to advancing trade and investment between Canada and Vietnam. I would also like to recognize and extend our heartfelt appreciation to our national corporate sponsors for their year-round support to the CanCham community. Canadian National Railway, Danone Foods, Export Development Canada, Sun Life, Vina Capital, Grant Thornton, La Vie, Manulife, PCA, and Tillich & Gibbons. Your support enables us to create meaningful platforms like today's seminar, where we can exchange knowledge and strengthen collaboration across industries. I wish you all a productive and engaging afternoon of discussions. Thank you, everyone. Back to you, Mark.
Okay, so I got to do a little housekeeping before we get rolling here today. So just so everyone knows, you are on camera. This session is being recorded from start to finish. Secondly, if everyone could just take a moment to turn their phones on silent, if they haven't done that already, just so we have no interruptions. Got to raise that back up, Mara. And lastly, the panel discussions or the case studies that will be happening. If you have questions, just hold those till the end, and I believe that we'll open it up to the questions after each session. So with that being said, we've got 4 top-tier firms with us here today. But before we jump into who's joining us and what that first session is going to look like, I'm going to introduce our moderators. We got Mike Herbert, who's the Country Commercial Director at Cognita Schools Vietnam. Mike is the Country Commercial Director of Cognita Group in Vietnam, a global leader in private education with 107 schools worldwide. In his role, he oversees the commercial and growth strategies of their 3 schools in Vietnam, the International School of Ho Chi Minh City, the American Academy, and the International School of Saigon Pearl. Those 3 schools are leaders in providing holistic education following the International Baccalaureate, I'm going to trip and fall over that word, Baccalaureate program at the AP diploma, or and the AP diploma. Mike is also the former president and chair, or president of Canadian Chamber of Commerce. Before moving to Vietnam, Mike had a successful track record in corporate finance in Canada with HSBC, Bank of Montreal, and Desjardins. Other than that, we have Ralph as well. Ralph is the founder and managing director of IFM Research. He's been in Vietnam for a very long time, 30 years. And after 20 years of corporate life, Ralph established IFM Research, Vietnam's first dedicated smartphone-based research agency with the largest consumer-based panel in Vietnam, offering full research services. Ralph set up TNS Kantar in 1996, including TNS Custom, TNS Consumer Panel, and TSN Media Forum 2010, served as Regional Managing Director, TNS Kantar South Asia. That's a lot of TNSs. He holds an honors degree from Wilfrid Laurier University, which is only 45 minutes from where I'm from back home, and is an honorary board member of the CanCham, having served as president, vice president, and board member for over a decade. So let's dive in. Our first firm, we're going to welcome to the stage, we have Mike moderating. So Mike, please join us on the stage. And speakers, we have Tran Ngoc Trung and Nguyen Chan Vinh. So going to briefly introduce our first firm to you all, which is Baker McKenzie. So Baker McKenzie is one of the largest international law firms with nearly 3 decades of advising businesses on complex domestic and cross-border matters. Recognized for leadership in M&A, tax, trade, energy, and compliance, the firm leverages its global network across 45 countries to deliver tailored solutions in Vietnam. A little bit about the representatives today. Ngoc Trung Chan is a senior regulatory advisor, specializes in international trade, customs, and tax, and brings unique experience as a former senior government official and current member of Vietnam's negotiation teams for tax and trade agreements. Tan Vinh Nguyen, partner and head of tax and trade practice, is a Chambers Band 1 lawyer for tax in Vietnam, with extensive experience in tax planning, controversies, and cross-border transactions. So please welcome this group to the stage, and I'm sure you're going to be enjoying an insightful conversation.
Yeah, good morning. Good afternoon. We're already in the afternoon. Good afternoon, everyone. So maybe I don't need to have more introductions. So first of all, thank you, CanCham, for having me flying all the way from Hanoi to enjoy a very cool and cozy afternoon here in Ho Chi Minh City. And so for this topic today, Vinh and I would like to bring to you a case which is very significant in the 2025 trade development in Vietnam, which is the on-the-spot export-import. So we will start it now.
So before we get into this, I'd just like to a little bit. So how long has Baker McKenzie been in Vietnam? And for both of you, how long have you been practicing as lawyers?
Okay, good afternoon, everyone. So very pleasure for me and Trung to be in this afternoon seminar with CanCham. Great to see all of you. So to answer your question, so Baker McKenzie, we just celebrated our 30th anniversary last year in Vietnam. So this is our 31st years in Vietnam. And I myself, I have been practicing law and tax with Baker McKenzie for 21 years, and I have 30 years experience in this kind of tax and customs experience. Over to you, Trung.
For the practicing for myself, I have been with Baker McKenzie for about 30 years. Focusing on international trade and custom. And before that, I have spent about 10 years working for the Ministry of Industry and Trade as a government official, focusing on the U.S.-Vietnam trade relations.
Okay, great. So let's dive into this case. Go ahead and tell us what it's all about.
Thank you. Yep. So as Trung briefly mentioned, in this session we are going to discuss about a unique export-import arrangement under the Vietnam trade regime that is on-the-spot export, and we like to highlight the importance of advocacy effort. First, Trung, what is on-the-spot export and why it is important to the business?
Yes, so as all you know that Vietnam is an exporting country, and So far, we export about 700 billion US dollar a year. And for the on-the-spot export, what we normally call for OTS, it accounts for about 150 billion US dollars, so about 20% of the total trade volume of Vietnam. So that you can see that it plays a very significant role in the overall international trade activity in Vietnam. So exactly what it is. So the ODS basically is an export-import arrangement where the Vietnamese, the local supplier here, they sell the goods to the foreign buyer. But there would be no cross-border physical flow of the goods. The goods still remain in Vietnam. Because that at the same time when the local supplier, they sell the goods to the foreign entity, the foreign entity will sell it again or assign it to another local customer. It can be the buyer, local buyer, or it can be another manufacturer to do the toy manufacturing in Vietnam. So for the transaction flow, it's still two transactions. One between the local supplier and the foreign entity, and the second one is for the local entity and the local customer. But you see, the goods flow is go directly from the local supplier to the local customer. And because of that transaction, why they need to do that? Why they don't just do as normal? It is because that, as I said, first it is cost saving. The goods will not have to physically transport into international water, so it can go directly from the supplier to the customer, so it can save the transportation cost. The second thing is that the foreign entity, they still maintain their trading right. So as you know that it is very standard in the current supply chain structure, where the local entity, they want to maintain their ownership in the goods, or where they want to maintain their relationship or their own network. So therefore, by doing that, they still be able to secure the control in the customer. And the third one is that the foreign entity, they will not need to establish a local entity in Vietnam to do the same thing. So imagining that if they have to have a local subsidiary here just to do the transaction, that would be more cost and more paperwork for them. And the last one is, again, time saving. Because the goods won't go directly from local supplier to local customer, it can be very quickly for the goods to back into the production chain. So that is all the benefits of the ODS, and therefore it's very important to foreign entity and also for Vietnamese manufacturer or exporter in maintaining this model.
Yeah, it's great to see the benefits of this on-the-spot export arrangement brings to the benefit, particularly to the supply chain in Vietnam, because Vietnam is like a manufacturing hub for many companies. But we understand that in the recent years, this kind of arrangement has been under challenge by the government, and the government planned to abolish this and replace it with another scheme. So what was the rationale of the government to abolish it? What was the intention?
Yeah, so the story back to 2022, when the government, first of all, the custom, they start to think that they need to have some kind of restriction or control on this model. Why they need the control is not clear. But here's that they take the view that the ODS model, first of all, they make the complication in terms of the custom procedure, because the goods still in Vietnam is going nowhere. But there have to be the export procedure and import procedure. So it makes it more complicated for the enterprise and more complicated for the authority in controlling. They say that they cannot manage whether or not the seller buyer won't do the export procedure or import procedure, because you know that in this model, the seller, when they do the export, they still have to pay the export duty if the commodity is subject to export duty. And the buyer, they still have to pay import duty if the commodity is subject to import duty. So therefore, the rationale here is that they take the view that because of that, the goods going nowhere, so they have no way to control the enterprise in the custom procedure. The second one that I think is more critical is that about the tax. So they see that the foreign entity in this model, probably they do nothing. But then they can gain a very high profit. Why? Because the custom authority, they looking into the custom declaration form. They see the custom value in the export declaration and the custom value in the import declaration. There's a big margin here. And therefore, it is the reason that they think that they are just have some tech leakage here, and therefore they want to stop it.
Yeah, and I understand that the challenge that the government used to bring against this case is that they refer to the law by claiming that this on-the-spot export arrangement is only allowed to a foreign seller when the foreign seller doesn't have a commercial presence in Vietnam. And with that reason, like the whole supply chain in the country in the recent years is really disrupted because the tax authorities and the customs authority try to challenge the local supplier when the local supplier exports, and the tax and customs authority try to challenge the local supplier whether the foreign company has a commercial presence in Vietnam, and how can the supplier know whether they have a representative office or they have a subsidiary in Vietnam. And the problem is that the local suppliers in many cases cannot claim the transaction as an export transaction. As a consequence, they cannot claim input VAT refund because the transaction is not considered as an export, and it caused huge loss of VAT cash flow for the business. So what would that challenge in the region? Can you just quickly mention what kind of solutions did you advise the client to overcome the problems during the recent times?
Yeah, so when we faced this problem, and actually it's a problem of many of our clients, what we're thinking of is that we need to have both the short-term and long-term strategy. And because when the MOF they launched this proposal, they saying that now because they don't want to use the enterprise to do the ODS, so they come up with the solution that now when there's three parties in this transaction, the foreign entity somehow have to transfer the goods to the local supplier, transfer back the goods to the local supplier, and then it's just a domestic transaction between the local supplier and the local customer. So turn everything from an export-import into a local transaction. Or in other case, when the foreign entities still want to engage in this model, they have to establish a local agent here in Vietnam. So everything from international trade become local trade. And at this point of time, what we advise our client for the short term is that we'll utilize the bonded warehouse model. As you know, bonded warehouse is a special custom zone where goods stored in that has been already exported out of Vietnam or had not been imported into Vietnam. So by using the bonded warehouse, we can somehow bypass this MOF restriction. But it's quite tricky that after we propose and some of our clients implement this model using the bonded warehouse, the MOF continue to have another official letter where they saying that if a local supplier selling goods to foreign entity and then store it in a bonded warehouse, it would not qualify as an export if the goods eventually imported into Vietnam, and therefore the local supplier still not be eligible for the 0% VAT. And it is very tricky here.
Yeah, so even that temporary solutions is more costly and more time consuming, but still under challenge. So what did you do to help the clients and the business community to try to engage with the government authorities and engage with the business stakeholders to bring back the on-the-spot export-import arrangement? Because as you just mentioned, this scheme is so effective, so efficient for the supply chain.
Yeah, so I think that is maybe the key part of the today seminar. We're talking about the experience on the advocacy, and in this case, when we have the request from or instruction from the clients to come up with a long-term solution, we have to develop an advocacy strategy for the clients to overcome this situation. So I think first, the first key takeaway here is that we need to develop a strong legal argument or foundation in order to produce counter argument against what the authority apply. So particularly in this case, when the authority is talking about the text, the main concern is about the text. We have to show them that actually that is just their imagination, because in no way when it turns into a local transaction, the local supplier can produce or sell to the local customer at the same price as the foreign entity does. So by doing that, even if they impose or they abolish the ODS model, eventually they will not meet the target in tax collection. So first of all, we have to develop the argument first. The second thing is about when we already have the argument, we need to gather the voice. Because if just one or two number of companies raising the voice, it's going nowhere. And therefore, in this case, the role of the Chamber of Commerce, the role of Business Committee is very important. And we have a law firm, we're very lucky that we are also a member of GRAS Chamber of Commerce, and that is the source to collect or to gather the voice together to raise the issue to the government. And maybe the last one, which is how we raise the voice. Of course, there's a lot of forum, there's a lot of dialogue where business community can raise the voice, but of course we back the state, we have to figure out who we should deliver the message. And in this specific case, the selection may come from the technical level first, because I was also a government official, and I know that when a decision from the decision maker from leader it won't come from the technical level. And from the technical level, when you be able to develop that message to them and to persuade them on how it should be going in the future, if this happens, then they won't be able to have some kind of influence to the boss. And also, a part of that, it also need to have some kind of going around when we do raise the voice to other agencies in the government in order to become a combination in order to achieve what we expect.
Okay, thank you. Maybe just one question from both, because I know we're a little bit on getting over time. So in a few words, in 10 words or so, can you share from the client side, what is the biggest challenge in this type of OTS structure?
Yeah, I think the biggest challenge for the clients with this challenge is that financially, their VAT input is stuck, and they cannot claim back input VAT credit because the transaction from the local supplier is not treated as export. And if that's the way, it's a cost issue. It increased the price, and it's like change the whole financial model financially.
Okay, thank you. And from the lawyer side, what is the biggest challenge when you're doing advocacy or working with a client on this type of transaction?
Yeah, I think the biggest challenge for us is to make everything balanced. Because each enterprise, they have their own interest. And in order to have the same voice, everybody on the same page, then it would be our role or our obligation to make analysis or doing some kind of discussion with each client in order to bring everyone on the same page.
Okay. Thank you. I would love if someone in the audience, we have a few, maybe we have time for one question or two questions. From the audience side, is there anyone either who have a business that's facing this type of challenge or just has a question around it?
Yeah, hi. Guys, thanks a lot. My question is to you, when you said, it's about establishing advocacy, all right? Long-term advocacy. We know in Vietnam, long-term is very long-term, all right? So my question is, how long would this advocacy actually be required to actually see change? Is it a year, 2 years, 3 years, 5 years? Any idea?
You mean for this particular case, or?
Yeah, say for this case specific.
As you all see that the Vietnamese government just released the new decree in maybe last month. So it takes about 3 years first to get the final result for this case.
Wow, thank you.
Yeah.
I think.
Congratulations on achieving the intended result. I had a technical question. The first argument you gave for the advocacy, you said it would be cheaper, the product would be cheaper if you go through this OTS system as compared to local supplier dealing with local customer directly. How is that? Only because of the volume that is being placed through the local agent? What is the reason for the price being cheaper in the OTS?
I mean, the cheaper here is not the price, but in the overall transaction. Because imagining that if you have to export the goods out of Vietnam and then re-import it back, then the cost would be higher. because of the transportation cost, the insurance expense. So therefore, and also one of the reasons of the MOF when they want to abolish this model, because they're saying that there's no country doing the same thing here like Vietnam. So only Vietnam doing this model. And that is the reason they want to abolish it. One of the reasons. Yeah.
We have Sammy. Yeah, I'd like, if you're asking a question, to use a mic because we are on camera.
Very quickly. What about the flow of funds with this OTS transaction? And is there raw materials coming or no raw materials coming?
Yeah, I can.
The flow of funds, who pays to who and how?
Okay, so for this kind of arrangement, from the local supplier perspective, of course, for them to produce the goods to deliver to the local customer, they may need to import certain materials. And so when they import materials, they can get exemption for importation of materials to be used for export production. That's the benefit. And in terms of the fund, the foreign entity will make the payment to the local supplier to buy the goods. And the local customer will make the payment to the foreign entity to purchase the goods. So there's no payment between the local supplier and the local customer.
So the local customer pays the foreign entity?
Yeah.
Just one additional question. Does the person who's importing the raw materials, do they have to have a contract beforehand to show and prove that it's an export to get the benefit?
You mean local customer?
The local supplier when they're
local supplier.
Yeah.
Yeah, so for the local supplier, when they import materials to be used for this OTS arrangement, they need to have to show to the customer the whole arrangement, this triangle arrangement.
Thank you.
Yeah.
We'll take one more from Ken.
So how does the foreign entity protect its intellectual property? What's to stop the local supplier actually just copying and then taking the customer base over time?
Are you talking about like IP protection or what?
Well, I guess so, yes.
Okay. So normally what we see is the foreign entity, when they engage the local supplier or engage the local customer to do toll manufacturing or contract manufacturing for them, they may enter into like limited trademark licensing agreement whereby they allow the local supplier to use trademarks for certain purpose within the context of that contract manufacturing or toll manufacturing only. And usually it is like royalty-free trademark licensing arrangement, but just for the sake of producing the goods under this arrangement.
Yeah, so maybe I want to add up here for this question. So what I see from the clients when they want to protect the IP here is that they won't like make a division. So they will not assign everything to one manufacturer, but they do maybe select 1, 2, or 3, and each manufacturer do a part of it. So in combination, they will get the fourth one to do the combination of all everything into the finished product. So by that, they somehow can manage their IP and protect it.
Thank you very much. Thank you, Trung, and thank you, Vin, for your time.
Thank you.
That wraps up our first case, so thank you both for your time.
Thank you.
Okay, perfect. So our next panel discussion is going to be from Teleke and Gibbons. So they're going to share some practical and legal tips on lawful employee dismissals in Vietnam. A little bit about Teleke and Gibbons is they are a leading regional law firm with over 250 professionals across Southeast Asia. Active in Vietnam for quite some time, the firm is recognized for its strength in corporate and commercial law M&A, Labor and Employment, and Intellectual Property with offices in Hanoi and Ho Chi Minh City. So with that, I'd first like to welcome Ralph to the stage as our moderator, as well as Sarah and Lynn from Teleka and Gibbons. So while they're making their way to the stage, I'll tell you guys a little bit about Sarah and Lynn. So Sarah is counsel for over 17 years of experience in Canadian and international law, with a focus on labor and employment. Based in Vietnam since 2013, she is recognized by Legal 500 and Chambers for her expertise, and she has advised organizations from the ILO to multinational corporations, while also serving on CanCham Vietnam's board of directors. Lynn is an associate. She specializes in corporate, M&A, and labor matters, advising clients across industries from technology to consumer goods. A licensed lawyer and member of the Ho Chi Minh City Bar Association, she brings nearly a decade of experience supporting international clients in Vietnam. So again, please welcome the group to the stage, and we're excited to hear the presentation.
First of all, just a quick one. Oops. Just a quick one before we start. So Lynn is representing Tillich and Gibbons, and Sarah is the client. Okay, so we can make this very clear from the get-go so we can follow it a little bit better, all right? So let me start off very simply by asking, can you give us a very broad brushstroke overview of what you're going to be talking about today?
Yes, so our topic today is about managing dismissals. This is a big challenge in Vietnam, so it's good for businesses to have some idea about this. So to begin with, just for people that are new to doing business in Vietnam, we'll give a very brief overview of termination. These are the simplest ways you can terminate an employee. If they are on a fixed-term contract, you can simply wait for it to expire. Your only obligation is to give notice before the expiry date, and the Labor Code doesn't specify how much notice, but we would recommend 30 days. So when you bring on new staff, we recommend to put someone initially on a 1 or 2 year term contract, just in case it doesn't work out, and you can just let the contract expire. The other way terminations are often achieved in Vietnam is through mutual termination. In these cases, the employer generally proposes it, the parties sign an agreement with a comprehensive release, and normally it's necessary to pay a settlement payment or ex gratia payment to incentivize the employee to agree. If the employee does not agree to termination, there's a number of bases upon which the employer can unilaterally terminate them. So there's poor performance. If the employee provides untruthful information during the recruitment process, if the employee is absent from work for 5 consecutive days, redundancy, force majeure terminations, we saw some of these during COVID, and dismissal. And dismissal is specific to the case when an employee commits an act of misconduct, and that is our focus for today.
Yeah, I will continue our presentation. So we would focus on the dismissal section. And as you may know, the dismissal is limited in Vietnam, especially for the permissible cases that the employer can dismiss their employee, that we will discuss in further details in the next slide. For generally, the Labor Code states that the disciplinary action may only apply where the misconduct is listed in the register internal labor rules, the labor contract, or the labor law. However, practically, we observe that the competent authorities and especially the courts always prioritize applying the principle of the internal labor rules over the labor contract or the law. In case of dismissal, there is no requirement for zero allowance or notice. And the employer can only dismiss their employee in the following cases. As you can see on the screen, there are 4 cases. The first one, the employee commits act of theft, embezzlement, gambling, assault, use of drug at workplace, disclosure of the trade or technology secrets, infringement of the employer IP, sexual harassment. Just a critical note for this type of actions, there is no need to prove the financial damage when dismissing an employee. And for any other action that is not listed in the first point, the employer needs to prove the financial damage that caused or threatened to cause the serious damage or very serious damage to the employer. The third case is employee recommit the same action or the same misconduct or offense while they are still in the period of discipline action, or they recommit the offense after being disciplined by demotion. And the last case, employees takes total of 5 days off in a month or a total 20 days off in a year without any proper reason.
So if you do have a legal basis for dismissal, it's still somewhat complicated. You need to hold a disciplinary hearing, and that means you need to send a formal invitation to the employee and to the representative of the executive trade union if you have a corporate level trade union, at least 5 working days in advance. At the disciplinary hearing, the employer presents the evidence. It's kind of like a little mini trial, and the employee and the trade union representative have an opportunity to respond. But regardless of their responses, the employer can make the decision at the end of the day. One thing to keep in mind is that very short limitation periods apply in Vietnam. It's only 6 months for most acts of misconduct, and the time begins to run from when the act occurs. This is a big difference from Canada and many common law jurisdictions, where the limitation period begins to run from the date of reasonable discovery, and it can be a big challenge. It's 12-month limitation period if the offense involves the employer's finances, assets, or the disclosure of confidential information. But again, it's from the occurrence of the act. So it can be very tricky, for example, if an employee has been secretly stealing money or something like that. If the 12-month period is over, the employer cannot take disciplinary action. So with that rosy picture, let's begin our case study.
So just very quickly, so Sarah, as the client, what was the issue that you brought to Tillich and Gibbons?
Right.
Sorry, I keep getting that wrong.
I have a business consulting firm, and our work is very stressful. One of my employees, Bill, got in a heated argument with his department manager, Sam, and he threatened to kill him. He stormed out of the office that day, but then he returned the next day as if nothing had happened. So, obviously, it creates an extremely tense atmosphere at the office. Sam was afraid of Bill, and the other employees were also uncomfortable around him. We were concerned about Sam's safety and the other employees and how this would generally impact morale at the company. Our company had registered internal labor regulations. These are the official working rules of the employer that are registered with the Labor Authority. And they stated that committing an act breaching the law was subject to delay of salary increase or demotion, but nothing was specifically stated about uttering a death threat. We wished to immediately terminate Bill's employment. We had already requested him to resign, but he adamantly refused. So we wanted to proceed immediately with dismissal.
Is Bill's case typical, or is this quite unique in Vietnam?
This particular fact pattern is unique, but there are many cases that come up where there's no legal basis for dismissal. So, for example, bribery is something that comes up from time to time when an employee has been engaged in corrupt conduct. It's a crime under the law, but it's not listed under Article 125 of the Labor Code. And it's only those listed offenses where the employer is not required to prove damages. If it's not one of those listed offenses, the employer has to prove that the conduct caused financial damage. And with something like bribery, that's very hard to show. Yeah.
Wow. Bribery is a big issue in Vietnam, as it is in a lot of Asian countries, but in Vietnam it's a huge issue. Now, from the client side, you've given what the real challenge is. From Tillich's side, what was the biggest legal challenge for you to help solve and advocate for your client?
Well, to be honest, like Sarah just shared, this is not a common case in Vietnam. And also, the biggest challenge for the lawyer side, it should be advising the legal perspective and risk, and also considering the practical impact on the client. For example, the death threat, as you may know, the practical impact may outweigh the legal risk. So the client would not listen to our advice, but they try to consider and balance the risk from legal side and from the practical side. We just always want to advise our client that just don't dismiss any employee without any legal basis, because that would be unlawful and resulting in a really tons of thousands legal costs as well as the damage for the client.
Now, having said that, what were some of the suggestions, solutions that you offered the client? What were some of the things that you said, hey, consider this?
The solutions, there are two practical and also the best case scenario. The first one is to attempt to negotiate for the mutual termination first. So this is the best case scenario. From what we can see from the facts in the practice, employees they rarely made any claim for the mutual termination. And if the mutual termination can be reached between the parties, the company may consider apply a lower disciplinary measure, such as demotion.
So the first one was mutual agreed termination with some sort of severance payout and whatever else. The second one is demotion. What else did you recommend?
I think this is just two solutions that
So then tell me about demotion. What does that entail? How do you go about demoting someone legally?
Well, again, you need to have the offense listed in your internal labor regulations, which must be registered with the labor authority. And then in the internal labor regulations, under each disciplinary measure, you list the acts of misconduct that would be subject to it. So basically, if you wanted to demote someone, it has to be listed under demotion. And when you draft the internal labor regulations, you should try to draft the offenses broadly, because you can't anticipate everything. Because no one would probably expect one of their employees to be uttering death threats at the workplace. So you could have something like committing an act in breach of the law, or treating colleagues with disrespect, something like that.
Okay. It does sound kind of daunting, doesn't it? I mean, Vietnam is sort of known as being, remember, it is the Socialist Republic Communist Party of Vietnam, right? Which means typically labor rights are with the employee, okay? However, I've been here 31 years. Let me give you an example, all right, of something that you can use which is well within the law. We talked about demotion, okay? Now, I actually had a case, all right, where how shall I say, absolutely poor performance, not showing up, whatever, but I wasn't able to do much about it, okay? So what I did, this manager was responsible, not my present company is awesome, all right? But a former company that I work with. This person had 4 people reporting to her. and one was a very junior that just started with the company. So I promoted him to become her manager, okay? It lasted about a week before she resigned, all right? There, in Vietnam, there's something called McKenzie, face. So you can actually use face to your advantage, all right? So there are ways around, okay? There always are, okay? But I think, going back, the key here is you need to understand the law, you need to follow the law to protect yourself, because it is a market that is very pro-employee, yeah? What about, I mean, Bill is, my next question is, what about problem cases? Bill certainly is one. From the client side, what did you do? What was the end result?
Well, actually, in this particular case, we proceeded with the dismissal. There's a provision under the ILRs that said we could dismiss employees if they committed an act causing serious damage or threatening to cause serious damage. So we went on the basis that it threatened to cause serious damage. And our good lawyer warned us that that may not hold up in court because you would still have to show potential financial damage arising from the misconduct. And that could be hard to show in this case. But we proceeded anyways because the risk of safety to our other employees was so much of a concern, and it would totally impact their morale in the office. So we decided that the practical risks outweighed the legal risks.
Okay, so you let him go and then said, okay, we'll see you in court if that's the way you want to go.
Right.
Okay.
And
Did Bill see you in court?
Bill never brought a lawsuit, and it could be because uttering a death threat is a crime under the penal code. So he might have been concerned if that he's presenting his case in court, there's evidence before the court that he committed a serious crime. So I think that deterred him.
Okay. Now, you also mentioned something about employees who have protected status. Now, there's two parts. One is government, whatever people or whatever else. I don't think that really matters in this room. But could you tell us a little bit about that?
Yeah, sure.
Am I protected?
No. Unless you're pregnant.
Yeah. There are certain cases for the protected status in terms of dismissal. The first type is the legally recognized leave for the employee, like annual leave, sick leave, maternity leave. If you're pregnant and raise a child under 12 months, so you're subject to the protected status. And the other two cases is if you are held by the legal authorities and have not been convicted yet. And the last case is you are subject to the ongoing investigation for the alleged misconduct.
Canada up with some ridiculous results with protected status. So, for example, so keep in mind, pregnancy and raising a child under 12 months are two bases for protected status. So let's say you have a female employee.
Keep being pregnant.
She steals money from you, and then she immediately informs you that she's pregnant. You have to wait 21 months before you can take disciplinary action against her. And so what happens is after the period of protected status ends, the employer gets 60 days after that in which they can take disciplinary action. So you would have to wait out 21 months, paying as usual, except for, I guess, the maternity period where the state pays. But, yeah.
Don't hire pregnant kleptos? Okay. Then I just one other thing I want to touch on. You noted that what happens when an employer doesn't have the internal labor rules and laws set out? What protection do they have, or what can they do in case of a dismissal case?
Yeah, like I said, like we just discussed about the solutions, mutual termination, and consider a lower measure of disciplinary action.
So even if I don't have labor?
Well, what we were saying before about face is very true. So in a lot of cases where an employer lacks the legal basis to carry out dismissal, they might have the legal basis to do demotion or something. And in that case, the loss of face often encourages people to leave.
Okay. Here's an interesting point. Recently, as you're aware, Vietnam went from 63 provinces to 34 provinces. And correct me if I'm wrong, Fred, you probably know this better than I do, but I think 6 ministries got folded into X number of ministries, right? And over 100,000 government employees were let go, all right? Now, if you work for the government here, you're very protected, okay? However, their job no longer existed because their workplace no longer existed, i.e. the ministry didn't exist anymore. So, for example, let's say if you have a production line or a certain part of your business, like let's say you have 3, 4 business streams and one of them goes under or whatever else, that is another way to potentially do that.
Yes.
But again, you still need to follow the law, right?
Yeah, that would be redundancy.
Okay, redundancy.
Yeah, so if you have a change in organizational structure, you can lay people off. It's you have to go through all the procedural steps, but you can do it. And then normally an employer would again propose mutual termination before going through all the redundancy steps, and then basically offer the employees what they would get paid under the redundancy, plus some extra as an incentive to sign the mutual termination agreement.
Before we go into the Q&A, I just have one final question for the both of you. For employers, all right, what is the single piece of really critical advice you can give when you're looking at dismissal of any kind?
Try to negotiate mutual termination first. Dismissal is very risky. Yeah, and often results in wrongful termination lawsuits.
Okay.
So it's really worth making that effort to reach a mutual termination agreement.
Okay, awesome. Guys, first of all, thanks a lot. Let's give it to the floor. I'm sure there's lots of questions about Bill. $10. Hey, that was my first employee here.
Is it possible for, in this case, if as your consulting firm and Bill in this aspect, you said, no, Bill, we still really like you, and although this happened, we're ready to make you the head of branch in Pleiku. Could you move someone to another office that's really undesirable and know that they will not make that move?
They have to agree to that. So any changes to the labor contract, like job description or working location, have to be consented to by both parties, and they have to sign an amendment to the contract. So you would be breaching the labor contract, and if you refuse to go, then you wouldn't.
What if his office or his desk magically gets moved to the cleaning closet?
Well, that is a good point, because the concept of constructive dismissal doesn't exist in Vietnam. In Canada, this is something employers really have to be careful about. Basically what it means is if an employer kind of makes the employee's working conditions unfavorable to incentivize them to leave, the court will treat that as equivalent to a dismissal. But Vietnam does not have that concept. So in some cases where it's really desperate dealing with an employee, sometimes they'll put the employee in an isolated office, and maybe they can find duties under their job description that are kind of undesirable, like filling out an Excel sheet or something, to encourage them to agree to leave.
Okay, any final last question, Jack? See, I know everybody's name.
Go Leafs.
Go Leafs.
Sarah, thanks for sharing. My question relates to the short-term limitation, 12 months after the act of occurrence. Mm-hmm. Well, what happens when the company only discover the act after the 12 months of occurrence? For example, a CFO committing embezzlement. Nobody really looks at that until you really need to look at that, right? Because CFO will the only person who knows all the accounting stuff. You're out of luck if you're your employer in that case?
Well, it's a crime. So basically you could report the person to the police, and if they get found guilty of the crime, they'll be locked up, and then the contract is over.
But you can't fire the person on the spot?
No.
Okay, wow.
You're safe, Jack.
No, I'm not CFO, but I better look at the accounting stuff.
One final question, and then we'll have a break. Going once, going twice. Oh, over there. Somewhere over here.
Oh, actually, no.
Oh, you're just stretching? Yeah, okay, all right. All right, look, what time is it now, Mike? 4. Okay, 15-minute coffee break. Coffee's out there, coffee, tea. Please be back here at 4:15 for the last 2 sessions. Thank you.
So next, if we could get Mike to return to the stage as our moderator, and then we now have Grant Thornton coming to the stage as well. So 2 parties from Grant Thornton, Valerie and Nguyen, if you could join us up on the stage as well, that would be greatly appreciated. So this session here is going to talk about a case study on typical tax issues that during audits and strategic planning to manage tax risks. The discussion will cover indirect transfers, intercompany recharges, profit margin challenges, and corporate income tax risks. So Grant Thornton, our company up at the front here, is a leading professional services firm with over 32 years in Vietnam, specializing in audit, tax advisory, and business process solutions. Leveraging a global network across 149 countries, the firm combines deep local knowledge with international experience to support sustainable growth for clients. So Valerie is a partner. She works in tax services and has been with Grant Thornton for over 16 years, has over 16 years of experience advising multinational clients across Asia and beyond, with particular experience in international tax and cross-border corporate matters. She has supported clients in diverse industries, including shipping, manufacturing, finance, and with a strong focus on Chinese-speaking markets. Nguyen is the Director of Tax Services. She brings more than 15 years of experience in tax auditing and corporate services. She advises multinational clients on tax compliance, treaty relief, and structuring for investments with a strong track record in market entry strategies and licensing for foreign investors in Vietnam. So welcome to the stage, and we're looking forward to hearing your session.
Maybe we get started with an intro to the first case, and I hope to bring some fun to tax tonight.
Okay, so before we go into the case study, we have 2 case studies prepared for today. So I will have Feng to just probably give an overview of what we're going to touch on today, very briefly.
Thank you, everyone. Thank you, Valerie and Mike. Good afternoon, everyone. As you have seen, Vietnamese tax landscape is going through the significant transformation in 2025. The tax policy is no longer just a tool for the tax collection. It's being used to drive the economic growth, attract investment, and encourage innovation. At the same time, the tax authorities are changing quickly. They are becoming more digital, more data-driven, and more stringent in their tax audit. And in just 7 months of 2025, we have seen that over 27,000 cases, tax disclosure that were reviewed by the tax authority, which is about 97% in comparison with the same period last year, bringing over 30 trillion Vietnamese dong to the state budget. Despite fewer audits than last year, the level of tax collection remains very high. And since 1st of July 2025, following the completion of administrative restructuring, the tax authority have resumed their tax audit. And for tax collection, of course, we are seeing the tighter control and more frequent tax audit, especially targeting the error with a high compliance risk. And here, let's see, now we can look at where the tax authority are focusing on. First, they are paying attention to the high risk indicator. This includes the company that, the big company that haven't been audited for so many years, the company that have the related party transaction or continuous loss, or the company that enjoy the tax incentive or apply for the DTA, the company file for the VAT refund, or they have the unusual financial activity. Second, there are some high-risk sectors that are under the closure watch of the tax authority. such as EPE, FMCG, electricity, real estate, infrastructure, and especially for the online business and e-commerce. These industries tend to have the complex operation and high value of the transaction, which put the company at the higher risk of non-compliance. And finally, the tax authority and also focus on the high-risk transactions. These cover the transactions like the ownership transfer, the cases where the company do not meet the condition for the CET incentive, or the payments for the technical service or royalties, or the expense involving the related party. We believe that understanding this focus area will help the company to proactively manage their tax risk and be better prepared for the future tax audit.
All right, so now we're going to jump into the first case, shall we?
Yes, great. Why don't you share with us? We're lucky today, Grant Thornton is presenting 2 different cases. So let's start with the first one.
Okay, so I'm here representing on the client side, where Feng will be the advisor from Grant Thornton. So I'm here representing a foreign invested enterprise that is based in Dong Nai province, and they have been operating in Vietnam since 1997. So in mid-2017, our parent company actually underwent a change of ownership of the true and offshore share transfer. So at that time, we updated our business license to reflect the new shareholder name, assuming that it's just like a routine administrative things that we have to do. And we didn't realize that this transaction actually triggers an indirect transfer of capital under the Vietnamese tax regulation. So then because of this, there's this thing called capital assignment tax. For short, we call it CAT obligation in Vietnam. And unfortunately, because we are not aware of this responsibility, so we did not declare or settle this tax at the point in time when we amend the license and when the transaction happened. So during several years later, during a tax audit, the authorities actually identified this transaction, and then they assessed a significant capital assignment tax liability. So this is approximately 45 million in VND, which is approximately like 1.7 million in USD. This was what was more concerning for us is also their intention to apply the tax on the gross selling price without allowing any tax deduction. So this actually is a very big amount, very significant amount for us. They also raised the possibility of tax evasion penalties, including fines of up to 3 times of the tax amount and late payment interest. So this is a very serious and unexpected situation for us. So we were facing significant liability for an offshore transaction in which we have no direct involvement. So recognizing the complexity and urgency of the situation, we know we needed expert help to navigate this around. So that's where we turned to Grant Thornton Vietnam, and their team worked very closely with us to understand the transaction and provided critical support through the process. So I'll hand over to Feng to share about how their team successfully assisted us to defend the case.
Is this like is there a lot of companies that face this type of thing? Is it very unique?
I would say that it's quite common, but what is challenging is that a lot of companies do not know that indirect transfer actually trigger a tax liability in Vietnam.
Okay, thank you.
Yeah. Thank you, Valerie, for sharing the background. Actually, when we are engaged by the company for this case, it was clear that the company was in a very big pressure due to the tax exposure up to 45 billion VND and the associated penalty. And we immediately sat down with the company to understanding the background, to analyze the case, and to set out the strategy to respond to the tax authority. But as per our initial review, we see that the tax authority, they simply apply 20% the tax rate on the transaction value, and it sounds like quite unreasonable, and raise the concern regarding the fairness and accuracy in their assessment. Yeah, so upon the review of the SPA, we identified the very critical point for this case. That is, the transfer price should have been excluded the value of the debt. And this is one of the key details that the tax authority have overlooked when they review the case. We have, together with the company, we have gathered all the evidence to justify for the deduction the value of the debt from the transfer price. And based on our finding, we have a challenge against the approach of the tax authority. We propose that the value of the equity value that's showing in the audited financial statement of the company should be considered as the deductible cost for this transaction. And after adjust for the value of debt, actually in this case, after the adjusted the value of debt, the equity value is higher than the transaction price. So which means that there was no CAT, no taxable gain for this transaction, and there was no CAT to be imposed.
Just to clarify, was this a transaction where the parent company was simply moving to a different, they were changing the location, or was it actually a sale of one company to a new owner?
I think both. I think a lot of people think that if they are just moving the parent company, there's no actual sale, probably just some internal restructuring. A lot of people think that since there's no gain, so internal restructuring, it will not be taxed. But that was many, many years ago, more than 10 years ago. Authorities still accept internal restructuring as one of the reasons. But unfortunately for now, even if it's internal restructuring, it will be subject to tax in Vietnam. So regardless whether is it a real transaction or internal restructuring.
Okay. When it comes to the tax authority's point of view, in relation to these offshore capital assignments and related to capital gain tax in Vietnam, what are their views on this?
Let me share about the view of the tax authority regarding the offshore capital transfer. We have seen that the tax authority in Vietnam now they are increasingly tighten their view on the offshore capital transfer. Over the past few years, we have seen that a growing number of precedent cases that the tax authority they challenge on the offshore capital transfer through the real case of Consulate Vietnam and many official letters confirming that when that the transfer of an offshore company which direct or indirect owns a Vietnamese entity is considered as deriving income from indirect transfer in Vietnam entity and therefore subjecting to tax in Vietnam. And the indirect transfer can be detected by the tax authority in many ways. It could be like through when the Vietnamese company they update their license, or through the review of the tax authority of the group structure in the audit showing in the audited financial statement of the company, or even through the public information on media. And so according to the current CAT regulation, any foreign entity generating income from capital transfer is subject to the CAT in Vietnam, regardless the transaction, where the transaction takes place. And so on this basis, the tax authority have a clear basis to impose the CAT on offshore capital transfer.
Wow, okay. There's a lot of companies here I can see that are foreign owned or you're all working for foreign companies, and I think this video will be shared in Canada as well. When it comes to common risks related to capital gains tax for an offshore transaction, what would you recommend?
Based on our experience, we see that there's some common risk, and of course we are going with some recommendation. Firstly, for some common risk, we can see that first one is the transfer price allocation. The current tax regulation is not clear how to identify the indirect transfer price, and so in practice we have seen that the tax authority they apply different method, different method, for example, to comparing the group assets versus local assets, comparing the group capital versus local capital, or the business valuation between the group and the Vietnamese company. This method will be applied on case-by-case basis, and in order to collecting more tax, understanding the possible approach from the tax authority will have the company have the proper planning and for preparation of the documentation and estimate the potential tax exposure.
Okay, thanks. Before opening questions to the audience, we'll go to the next case right away, and then at the end, if we have extra time, then we'll take questions on either of those cases. So can you let's go to case number 2. Again, as a client, can you tell us what was the situation?
Okay, so for this case, it's also a typical case in Vietnam. So my company is a 100% foreign invested company in Vietnam. So we are operating as an export processing business. So we specialize in manufacturing and servicing high precision equipment for the aviation and marine industry. So with majority of our goods actually export to our parent company in France. So to ensure smooth and efficient operation in Vietnam, we receive management and service support from our affiliated companies within the group. So during a recent tax audit, the tax authority actually challenged the tax deductibility of this service fee, particularly those recorded under the general and administrative expenses. So their initial position is to allow everything, the whole amount. Significantly, this will definitely increase our corporate income tax. We call it, for short, CIT. Liability not only over 1 year, because they did conducted a tax audit for 5 years. So it will significantly increase the CIT over the 5 years. So definitely it's a very serious concern for us. So these services actually are very essential to our operation. So it covers areas like engineering support, quality assurance, strategic planning. So we actually had documents to substantiate and justify all these charges. So, but the authorities, of course, they were skeptical when they come in to do a tax audit at the very initial period. And they also questioned about the necessity of such services provided by our affiliated companies. So then we engaged Grant Thornton to help us to navigate this challenge. And Feng will now walk you through the technical approach of the team and some key takeaways for this case.
Thank you, Valerie. For this case, our team has worked closely with the group tax and finance to estimate the tax exposure and identify the key tax risks. Actually, for this case, the management charge is quite common in Vietnam, and for this case, we divide into the 2 categories. The first category is those are requiring the further explanation and supporting document. And the other is requiring, like we say, that need more strategic negotiation with the tax authority. Yeah, you smile means that you understand what I mean, right?
Strategic negotiation.
You don't understand, you haven't been here long enough.
Yeah. So for the first category, that is the big portion, the very significant amount that belong to the technical service. And we have advised the company to relook at their data and to work with the group to collect all the evidence that proving the service actual render. It could be the all the timesheets of the expert delivering the technical support, delivering the training, all emails, correspondences, meeting agenda, or like the training program, and they. And then this include, and the more important thing is they need to prove that the service support, the service fee is essential to the business activity of the company. And so the client and their team has tried their best to to work and to collect everything, to compile the documentation. And then after that, Grant Thornton has prepare, reorganize everything, track to everything, and prepare full package of document for each year and submit to the tax authority, together with the FCT declaration, payment voucher, and transfer pricing documentation. After many rounds of discussion, explanation with the tax authority, finally we got their acceptance on deductibility. yeah, and we come to the strategic negotiation.
Yeah, so I was going to say, like, no one wants to have the strategic negotiation.
Yeah,
And some trade-off, right?
Yeah, so for the second part, that's the smaller one, that is the G&A expense. The company admit to us that the evidence cannot be found because it's quite long already. So that's why we decided to put this one into the strategic negotiation. And finally, the company accept the disallowance of deductibility as a trade-off for negotiation with the tax authority, and we avoid the further dispute. Yeah.
All right, so we'll say I'm a FDI company and there's a lot of them, and now with the world and having offices in Dubai and Hong Kong and now moving to Singapore, we'll say I don't want to have a strategic negotiation. As a management team, as management recharge transactions, these are common. Is there a typical risk or strategy that one company should employ before they have to have this negotiation?
Actually, the management chat is quite common in Vietnam, and we call that as the common risk, common challenge from the tax authority also. We have seen that the tax authority challenge a lot on whether the service is actual render or G&A benefit to the company in Vietnam, or they also challenge on the sufficiency of the documentation, whether they have contract, invoice, or the work performed evidence. And the tax authority also argue on like the arm's length principle of the expenses. So here are some recommendation. First is the company need to like have a very clear interco agreement with the clear and well-defined scope of work, pricing method, and benefit to the Vietnamese company. And also the tax obligation need to be very clear in the contract. Secondly, you need to maintain all the evidence proving that the service is essential to the business of the company by maintaining the management report, maintaining the training record, everything. And next, it would be the transfer pricing documentation, declaration, and benchmarking study. And also the invoice need to be issued with the correct name, with the sufficient backup, and the FCT declaration.
Thank you. We have a few minutes to go before the next panel. Tax, I know you all love to talk about tax. I'm sure there's a question out there. Please. A lawyer asking an accountant a question. This is going to be fun. Two lawyers. Oh, wow.
Hi. Thank you very much for these two very insightful case studies. On both, actually, my question relates to both. Do you see the tax authorities becoming more aggressive on this type of cases in terms of, well, the reassessment amount? You mentioned in the first case that they just came with a straight reassessment up to the transfer price. And in terms of their willingness to negotiate, and I recognize that you've achieved in both cases a very good result, but I would like to understand from you your experience and perhaps how this is evolving over time. Have you seen a change in the recent
I think
years?
if we can relate to the first case on the capital gain tax, so there's a lot of changes you guys know about tax regulation, some effective in July, some effective in October, this October. So you can actually see the government is trying to make things easier, clearer for the taxpayer, and easier for the authority to actually collect the tax as well. So there's significant change in terms of the, because in Vietnam there is no separate capital assignment tax. It's either CIT or PIT. So there's in the CIT law, the new CIT law, you can actually see that the government is already doing something to make it clearer. But of course, the new CIT law is there, but the degree and the circular that's guiding it is still not out yet. So we are still waiting for them to issue something on that before we can provide better advice.
But more in terms of your experience, have you seen the tax authorities becoming more aggressive? Or?
Yes, definitely more aggressive. And like what Feng mentioned just now about price allocation, how do we allocate the price to the especially the indirect? So there's no fixed approach at the moment. So there's Feng mentioned there's a few possible approaches that the authority may take, but then again, it depends on the business, it depends on the company, business activity, it depends on each authority, each officer or different province, they may have different ways of interpreting it, yeah.
All right, we'll take another question, if we had one. You know what, do you mind if I go with Sammy? That's okay. Hear from the business side. Or, sorry.
I'll just ask one quick question.
Yeah, sure, go ahead.
Just on case study 1 about the indirect transfer, is there a sort of, I couldn't quite understand the fact pattern. Is company B the only asset of company A?
For this particular case, yes, but we do have clients that may not be the only asset. They may have many Vietnamese entities.
So I'm trying to understand, in every indirect transfer where you have a Vietnamese subsidiary, some portion of that gain will be taxable in Vietnam?
Yes.
Correct.
I see.
That's
Okay.
right.
Oh, Simon?
I heard from one tax consultant at these big four, not important ones. Here we have Grant Thornton, that they're going to change the law so that the capital gains tax will be 0.2% of the transaction value. They say the same like, that's the question actually, the same like if it's sold to an individual. So is it true that if the company is sold to an individual, the capital gains tax is only 0.2% of the transaction value?
No, I think that the seller is the party to bear the tax, to responsible for the tax. So it means that in case that you need to reconsider that the seller is the corporate or the individual.
How can this thing about an individual being the seller? And how can we restructure this transaction? I mean, I'd restructure it, change the ownership of the company in Singapore without changing the name and registering here. But is there another way where if an individual is involved in the middle, then you can reduce the tax?
Actually, for the current regulation, we say that we have something to do with the ownership structure between the corporate or the individual to reduce the CAT. But of course, we need to review case-by-case basis to have the further consultation for the case.
Yeah, and because the authority will know as well if we are trying to do something on that, we're just going to change the ownership to an individual in order to save the tax. And if the time to do that and the actual indirect transfer is so pretty close that the time frame is very short, so it will actually, the authority will actually knows about this, that you are trying to do some tax planning there. But so they still have the right.
Within the law, you space it out. If you space it out, for example.
If you space it out, of course, it's not that obvious. Yeah, okay. But it doesn't mean that the authority doesn't have the right to do that.
Okay.
I see a lot of hands. I know we're running really tight on the next case. I'll go with one more question and then we move on. Oh, from Grant Thornton to Grant Thornton.
No, it's really a comment, because when we get clients coming into the market, they're always looking for tax advice on tax structuring. But that's to come in, and very few people actually think about going out. So I think there's a message there that you should be looking at both the tax structuring for the inbound investment and if you want to exit.
What age do you have to be thinking about going out?
Well, I'm 77 and I'm still here.
Thank you. Thanks a lot. Thank you, Fung. Thank you, Valerie, for that.
Yeah, thank you, Mike.
And on to the next one.
Thank you.
Excellent. Thank you, Mike. Thank you, Valerie. And thank you, Fung. So moving on to our last panel of the day, last but certainly not least, we have DFDL. And so from DFDL, we have Jerome and Standre here with us, as well as Ralph going to be moderating. So Ralph and the other two gentlemen, if you want to join me on the stage, that would be greatly appreciated. Our discussion for the final session will be around M&A structuring. So we're going to talk about the challenges of acquisition of a manufacturing, our final session comes from DFL discussing M&A structuring challenges in the acquisition of manufacturing multinational enterprise. This case study will cover aligning legal and tax structuring with commercial intent and navigating business vertical separation. So a little bit about DFDL. They have regional legal tax expertise. They've advised clients in Vietnam since 1995 and established offices in Hanoi and Ho Chi Minh City in 2006. They have 3 decades of experience across Vietnam and the Mekong region. The firm is recognized for its strength in M&A, private equity, tax, and complex cross-border transactions. Consistently ranked among Vietnam's top law firms by Chambers, Legal 500, Asia Law, and IFLR. So Jerome is a partner. He's been Vietnam-based since 2004 with deep expertise in M&A, private equity, and capital markets. He has advised leading international financial institutions and is consistently recognized as a top lawyer in Vietnam. Standre is a partner, co-leads the firm's regional M&A practice and specializes in cross-border transactions, corporate structuring, and employment compliance. Recognized by Legal 500, IFLR 1000, and Chambers, he has advised clients across sectors from logistics and energy to hospitality and insurance. So please welcome Jerome, Standre, and Ralph to bring us home.
Okay, let's just simply start off. So Jerome will be DFDL and Sondre will represent his client. Before I start, I just want to say personally that DFDL has helped us expand into Cambodia and Myanmar, so I can attest that they are good at what they do. All right. Where's my bribe? Okay. All right. So, Jerome, why don't you start off by just give us an overview of what this case study is about?
Actually, we were intending to do the opposite with a client, explaining
I'm
the
setting
case
the
first.
scene for this one. Yes.
Okay. I'm so confused.
Okay, so as the client, I represent international player in the semiconductor manufacturing distribution business. As part of through a auction sale process run by an investment bank, my company or employer intends to acquire a semiconductor business with a parent company through a French holding company. It has several subsidiaries across the region, including Indonesia, Thailand, and Vietnam. As part of the sale, the rationale for us to acquire this business is it's an expandatory acquisition, and we're looking to become a global player in the semiconductor business. As part of the acquisition, what complicates this transaction is, as part of the acquisition, the seller, with its semiconductor business, insists on the buyer also acquiring its special wires business unit that it houses in a separate Vietnamese subsidiary. This separate Vietnamese subsidiary is parented by a Singaporean holding company, and the subsidiary, or this Singaporean holding company group, houses the seller's entire wire manufacturing business activities. Specifically, this particular business unit that the seller wants to get rid of is one of 4 distinct business units that the seller operates through this Vietnamese subsidiary. The rationale for the seller to sell this particular business unit is because it employs specific processes and technologies that the seller is simply not interested in maintaining after it sells its semiconductor business. Just for a little bit more introspective, the semiconductor, at least the special wires business unit, is not something that us as a seller, buyer, is particularly interested in. It's not something that's important to our semiconductor business. We see it as more of a commodity that could be sourced elsewhere. So it doesn't necessarily need to be internalized into our semiconductor business after acquiring it from the French holding company. So after some consideration, because of the firm position of the seller and doing some number crunching, we put in an offer to secure an exclusive bid under the auction process, accepting that the transaction will be for the semiconductor business as well as the special wire manufacturing business unit. We approached DFDL as counsel, but they were an easy choice because they have a wide footprint in the region, and they obviously have offices in Indonesia, Vietnam, Thailand. That's right. Yes. So over to you, Jerome, to advise on the structuring options.
So just before we start, obviously you've got multiple stakeholders here, and you have splits of subsidiaries. Is this quite a common case that you receive, or is this quite unique in itself?
Well, this is fairly common for a business of this size, and this is where actually an investment bank is selected by the seller to organize, well, something that makes sense for presenting the business to the best in the best way, and also to gather the interest of interested buyers. So I think in this situation, our client had already talked to various investment bankers about their interest in growing, and through connections, the investment bankers running the auction came to our client and offered this as an interesting buy for them.
Okay. So great. So now, what was the next step for you? How did you, as DFDL, approach this issue?
So we were working on the Southeast Asia aspects of the transaction in Indonesia and Thailand. Our colleagues were looking at the business there. In Vietnam, it was a bit different because we had basically two sides of the business to look at. As the client mentioned, the special wire business wasn't really something that interested them, and we will see that this created a lot of complications for the structuring of this transaction. So we are normally hired for looking at the business that is for sale when the buyer looks at it, and due diligencing it, making sure that the business has been run in compliance with law and tax. And also, once we've assessed whether the asset is well run and compliant and okay to buy, then we look also into ways to actually make the transaction happen. That's more of the structuring. And then we help implementing the transaction. So here we had both a legal and tax scope. Coming back to the presentation of GT earlier, here indeed, there was a Vietnamese subsidiary here and another one here. And what was for sale is a French holdco. So obviously there was some tax implication on the transfer. I won't spend much time on it, but this is a typical case answering the question over there, where Vietnam tax will apply to this transaction. When the US seller will sell the French holdco, there will be a tax declaration to be filed locally and taxes to be paid if there is a gain that is determined based on this declaration. So we looked at, for Vietnam, can you move the slide? We looked for Vietnam as this Vietnamese subsidiary, and we looked both from a legal and tax perspective at the possible issues of the running of the business. And we've identified two major issues. One, big tax flag, which was a non-compliance that has been ongoing for a while, and very often when this is not unusual to find in a transaction, but what is unusual is where the situation is such that the buyer doesn't want to deal with it. There are always ways to solve issues you identify in an acquisition, but sometimes either because you don't have the appetite as a buyer, or because the issue is too complex or not easy to solve, then you don't want to deal with it. That was one issue, one big flag. The second flag we identified in the Vietnam semiconductor business was construction permit of the factory, which was where the operation was run, which was not properly issued and wasn't covering the whole factory. So these two flags made it such that our advice to the client was, you're going to have big trouble there. Do you really want to have these big troubles? Or do we find a solution to go around these? And the client decided that they were new to Southeast Asia, new to Vietnam. They didn't want to have big issues in the future, and they didn't want to deal with it. So they asked, when they had secured exclusivity and the process was well advanced, they asked the sellers to deal with it and to find a way to extract the business of that subsidiary into a new subsidiary, which would receive the business of the semiconductor, and that entity would be transferred by the seller, by that French holdco before the actual transaction of our client buying the whole group, to another part of the group of the seller, so that this wouldn't be part of the transaction. The tax liabilities inherited wouldn't be inherited because that entity would go away, would be going out of the group, and we would extract the business to a new entity. So very often this is difficult to implement. This is what we call an asset deal. And it's difficult to implement because you need a new entity, and a foreign invested entity to set up takes time. You need a lot of licenses. In some instances, you need a factory. And so this was a complication for the whole transaction. Setting up a new entity, dealing with the industrial zone to get a similar factory inside the same zone to be able to host the business within the new entity was taking time and had a big impact on the whole transaction. So this is the way we solved these two big flags that we identified in the due diligence by having a new entity set up by this French holdco that would receive the business of the Vietnamese subsidiary, and that Vietnamese subsidiary being transferred by the French holdco to somewhere else in the group of the seller. For the seller to deal on their own with the tax issues and the construction permit issue.
Just on that one, so outside of the first couple of points, I think the key challenge, and I think the key thing that the client had to do, is then agree to set up and sell the other element, correct?
That's right, yes.
And was that difficult? Was it a management board decision? Was it easy to implement?
Yes, I think the complexities arose through the timing and having to coordinate it with your other primary transaction, the sale of shares transaction that happens at holdco level, because there would be obvious delays in setting up an entity in Vietnam and getting it licensed. So this ultimately complicated the transaction tremendously.
But was that done outside of Vietnam or within Vietnam?
The discussions.
The selling off.
The selling off was within Vietnam.
Within Vietnam.
Yes. It was a new company that wanted to be set up in Vietnam.
What kind of time frame?
1 to 3 months to set up a new company. But as Jerome might point out, there was a specific license that became the real issue for us because it extended through up to 1 to 2 years to get. So.
And sorry to ask, but we all know that Vietnam is going gaga for semiconductors, this whole intent to move up the value chain, right? Did the fact that it was semiconductors have any impact at all or no?
For sure, I think there's a real push or incentive by the government to have these type of factories set up in Vietnam. In this particular transaction, I think Jerome engaged with the authorities.
No, it didn't have any impact because that's down the line, local authorities dealing with it. It didn't have any impact on how this transaction unfolded. But so we discussed only about the easy part so far. The business that our client didn't want, which really was the big complication factor in all this. So if you can move to the next slide. So as Tandre explained, this other part of the business of the seller, the wires business, had this special wire unit, which the seller really wanted to get rid of, and said, well, I'll put it together with the semiconductor business, because I don't want to keep it. I'm selling something, so I'll sell it with it. There was some rationale for including it. But as Stanley said, special wires are a commodity. You can get them very easily from, there is not much IP with it. So why, as the client thought, why keeping it? Well, they didn't have a choice. So we needed to take it. And so there were other units in that Vietnamese wires subsidiary. We looked at the compliance of the company and it looked fine. The tax compliance was fine. So we said first, well, we will try to keep everything as it is and get rid of the other units. So get rid of these units, set up a new entity. So the holdco, Singaporean holdco of the seller would set up a new entity in Vietnam to receive these other units. So we have this Vietnam Wires subsidiary with only the special wires business in it to continue. That was a preferred option. That would have been very clean and very easy to implement. The issue with this is the Vietnamese wire subsidiary was holding real estate and transferring real estate. So the real estate wasn't part of the deal. They were only selling the special wires business. So we couldn't, well, if we were going to transfer these units, we would have to transfer the real estate as well. And transferring real estate is always very complicated. It takes time, and that wasn't working in the scenario. The seller didn't want to bother changing everything in their organization for just this transfer of special wire.
So what was done?
So what was done? So, well, it was not an easy call. So we looked at extracting that. Can you come back? Yeah, extracting that special wires unit only from that Vietnamese entity to another entity. So that would be, well, perhaps the Vietnamese semiconductor business that would receive it, or that would be another new entity set up in the group before the closing of the transaction, so that the business at the time of closing would include the special wire business unit. Now, to run a special wire business unit, you need a specific license, which is called a plating license, which is very difficult to obtain. The authorities are taking the view that there shouldn't be more than a number of these plating licenses per province, and that made it very complicated to, within the time frame of closing of a transaction, setting up a new entity, having these special wires, special plating license in place before the closing of the business. So what did we do? Well, we found another way. Or we thought about another way to buy the assets, the production line for the special wires. So the buyer or the group that is being purchased would actually acquire the assets, but wouldn't be able to operate them because within the time frame of closing, there was no time to obtain this special license. So what we thought about was the buyer will buy the assets and would lease the assets to the Vietnamese wires business for the Vietnamese wires business to continue use the assets and produce the special wires products and sell them to the buyer. The issue with this was leasing assets in Vietnam is a business that requires a license itself. So our client would have needed to set up a company which would have leased and gotten a special license for leasing. And that was A, time-consuming, B, more importantly, the assets were already used. And there are restrictions on leasing used assets. So this wasn't an option. So how did we do it in the end? Well, because it was complicated and time-consuming to transfer this and to obtain the special wires license, what we did was using, can you move to the next slide? So we would have the Vietnamese, no, that should be, yeah. So the Vietnamese semiconductor subsidiaries that we mentioned about, because of all the tax liabilities and problems with license, was back under the seller at the time of closing. The assets of the semiconductor business are transferred before closing to the Vietnamese NewCo, which is fresh. And that entity, next slide please, that entity is going to order from the seller's wire subsidiary the products, the special wires business, the special wires products, and next slide, the assets will be purchased down the line because we are buying them, we're supposed to buy them, will be in 2 or 3 years when the Vietnamese subsidiary within the semiconductor business group has obtained the plating license, will purchase the assets. In the meantime, the subsidiary of the seller will continue producing the special wires and selling them to the Vietnamese NewCo with the plating license that it has already. Within 2 to 3 years, which was the duration of the call option by the Vietnamese NewCo, the Vietnamese NewCo would find a way to obtain the plating license and would set up a factory to host the production line.
Sorry, Jerome, can I stop you there for a sec? Have a seat. My brain feels like a pretzel right now.
Because you don't see the... You don't
right?
See the
no, look, I think the point here is that, you know, that famous saying by Albert Einstein, you know, trying to do the same thing over and over again, you get the same results. Obviously, they looked at 25, 35, 55 different options to make this happen. So I think the point here is this is a very difficult transaction, but they were able to achieve the transaction and make it happen within the allotted time frame, all right? Now, you all know that a lot of us have negative things to say about lawyers, such as, what do you call 1,000 lawyers at the bottom of the ocean? A good start. However, I think this has proven that lawyers have a huge and immense amount of value in Vietnam, and that without them in Vietnam, you can't go anywhere, all right? So I just, wow, I mean, do you... My brain hurts right now.
But so, I think it's important to mention that this is an awfully complicated situation for a deal that shouldn't have been that complicated. I mean, Southeast Asia was only a portion of the business. Vietnam was not a tiny part of the business, but was a small part of the business. The assets, which were the most problematic, were actually the one that the buyer, our client, didn't want. So this is actually reflective of how Vietnam can be very complicated in some situation, because the regulatory system is unlike the one in more developed countries. Some is inherited, some is maintained for bad reasons, some is changing, and this is the takeaway. Things are changing very fast and changing for the good. So I wouldn't be surprised if in 10 years' time, this kind of situation won't happen. And we wouldn't have our client facing so much complication for having assets, part of a deal, an offshore deal that involves Vietnam assets. The deal was concluded, yeah.
Questions in a sec. But for our friends in Canada who will be seeing this shortly, pretty soon, basically, look, Vietnam is still complicated in terms of its legal framework. There's a lot of gray area. But I think, as Jerome has diligently pointed out here today, there are ways of getting things done, and things are becoming better. Yes?
Yeah, and also a deal in the end can look very different from what it looked in the first place or what it might have looked in the first place. Right. I think this is also showing the importance of preparing a sale. A diligent seller would have identified these issues up front and would have probably come up with solutions. Hence, the need when you want to transfer your business to actually prepare it, hire lawyers, accountants to look at it from No, but this is money saved in the end because delays in the transaction, especially in Vietnam, is very likely going to impact the valuation and sometimes the life of the deal. And so the number of deals which die just because of delays in Vietnam is huge. So if you want to maintain your valuation and have a good chance to close a deal, then prepare for it. Prepare for it by identifying, well, there will be a tax payable at this point of time. And someone sitting in the US would never think about this. Well, if you are well advised, then you prepare for it, and you prepare the documentation for it, and you know that you come with the right valuation for your declaration at the time of declaration. You identify that there is a big tax issue, and perhaps you start fixing it ahead of time. You identify that there is a big issue with this plating license, and without it, then this business cannot be transferred, and you find a solution ahead of time.
I think the point is call the FDL for something like this. Before we move into the final questions, I remember Fred Burke from Baker once showing me the amount of paperwork required to open up a company here. And they had like a dining room table that could seat, the Royal House of Windsor, 40 people around it, just filled with paperwork. It's not quite the same today. But that was a mere, what, 15 years ago? 15, 20 years ago, right?
It's actually just a stall at Diamond Plaza for retail.
Right. So look, for the audience, things are, don't be daunted. Things are possible here. Ask the experts, ask the professionals. Do not come here and think that what you do in Canada or the US or France works here. This is a different country, ladies and gentlemen. So I will now take any questions from the floor, like how do you unpretzel my head after that? Over here, the gentleman in the gray.
Yeah, since puts and calls are post-closing obligations, since puts and call options are post-closing obligations, how do you incentivize the parties to behave? I mean, usually motivated buyers, motivated sellers behave up until closing, and then post-closing, it's a loose end, right?
So just for the record, this is a question from the FDL to the FDL.
It was not pre-canned. I didn't know their presentation.
And he wasn't part of the deal, so he doesn't know the answer. So there were two mechanisms in this transaction. There was an escrow, which was meant to leave for a period of time over the period of the option. And the client knew that the option would be exercised within the time frame of the escrow. So that was one element. The other element were other assets that the buyer and the seller had in common, they found while in the process. So there were other business interests which were reassuring that the parties would continue behaving. And there were the usual guarantees by the sellers that that subsidiary would continue behaving and comply with their obligations under the call option.
Another non-DFDL question? Or are we still unraveling our brains? It's a little piece of wire, you see. It's the thing that Americans can't make because their hands are too big, okay? So if there's not any other questions, I'd like to hand, first of all, thank you very much, Jerome and Sandra, that was fantastic. Fantastically convoluted. I would like to hand it over to Mike for, I think, final comments. Is that right? Oh, sorry, Mark?
Yes, sir.
Well, I'll keep it in the family, all right?
And Jerome, don't listen to Ralph. I think that was a pretty simple transaction. So yeah, I think I'll say that as I'm staring at my roof tonight, thinking about the 14 subsidiaries, the U.S. buyer, the put call option, the purchase agreement, etc. But to close out today, I wanted to invite Mara back up on stage, our executive director, for some closing comments. So she's going to kind of wrap up there, and then after that happens, we're going to invite all of our panelists for today, our speakers for today, to come back up on stage.
All right. Thank you all for joining us this afternoon and for the thoughtful discussions and insights shared during the seminar. At CanCham, our vision is to support our members and the broader business community by providing connections, advocacy, and opportunities that help businesses thrive in Vietnam. Events like today's seminar are one way we fulfill that role, and by bringing together leaders, experts, and stakeholders to address key topics that impact us all. Whether it's through business seminars, networking events, trade missions, or community initiatives, CanCham is here to serve as a bridge between Canada and Vietnam, connecting people, ideas, and opportunities. I would like to once again thank our speakers, Mr. Trung, Mr. Vin, Ms. Valerie, Ms. Fung, Ms. Sarah, and Ms. Lin, and last but not the least, Mr. Jerome and Mr. Sandre. And our moderators, Mr. Mike Hubert and Mr. Ralph Mateus, and our MC, Mr. Mark Dickens. Thank you very much. We look forward to welcoming you at our future events and continuing to build a stronger and more connected community together. And once again, thanks to the Consulate General of Canada in Ho Chi Minh City, and thank you. Have a wonderful evening.